So let me show you some patterns that I do like. I've already talked about the plays that I like to buy, but frankly, I'm also a little bit favoring of short selling, just because I've had so much experience and I've seen so much crazy stuff over the years. Here's one of my favorite stories. Making $30,000 in one day from a rest stop in Molly Pitcher, New Jersey. This was before Profitly was built. I was actually driving down from New York down to Florida. Um, I was crazy a few years ago, and I wanted to take a road trip to actually build Profitly from scratch with my programmer who lived in Florida. So I had just gotten started with my road trip, and I was short big this blatant pump WLOC. And let me show actually a better chart. I think there's one. Okay, so right here. So you can see, the stock was up over the course of November, December. This was 2011. Um, and it was up nicely, or 2010 actually. It was up nicely from 25 to 70 cents, but then it kind of hit this wall. And it dropped from 70 and it had a little bounce. And the whole thing was, could it crack 60 cents? Remember in the last video, I was talking about how, sometimes you have these breakouts that break out all the way and then they come right back to the breakout level. And then it's a question, can it, continue to break out? Can it be a confirmed breakout? And in the examples I showed, that's true. In this case, it broke down, bounced a little, and then the question is, can it break this key 60 cent a share level? You can't short right when this is dropping. You can't wait for this to crack. Sometimes with shorting, as you'll learn, you need to reserve the shares ahead of time. And when it starts cracking, it really cracks. Here's another intraday example of how it dropped from 60. I guess you could have gotten a little short off here at 50 cents, but this was intraday. There's morning spikes and there's morning panics. And there's no news on this stock when it drops 50% on the day. But it was awesome. And I absolutely banked on it. Let me see that blog post. Did I show my trade? This was from literally 2011. Yeah, so this was my trade. I made roughly 30 grand. And it was my biggest gain in years. Again, because I had been trading small in order to teach. LX21, who you will hear from later in this guide, he made 41 grand. This was the old Profitly. But he shorted and he banked 43%. And this was I took pictures because some people don't believe that I can trade from anywhere. I take pictures and videos of everywhere I trade. And this was Molly Pitcher, New Jersey. I was at a rest stop and I pulled over from my road trip in order to trade. I didn't have to, as it turned out, the pump just kept dropping. But when you make 30 grand during a road trip, I like to pull over. And then I actually did a webinar. This was the chart before it cracked. And the whole question was, could it break 60 cents? And as you can see here, it did very quickly. And I did this webinar. This was from a random Kinko's in New Jersey. And I did a webinar just because I was like, I have to, explain this pattern to everybody. So I really like short selling. I like that initial crack, or, trying to find signs of the initial crack. Here are some more examples. This is hemp, HEMP. This was up, from 12 cents to 33 cents on the whole marijuana craze back when, GRNH was spiking too. And this one didn't have necessarily the big morning spikes, but when a stock like this doubles or triples, and the volume starts to fade, you can see the volume, even though it's up here at 33 cents and 30 cents, I mean, it is up from like the 20 cent a share region the previous day. The volume has faded a little bit and the stock is now a triple. And this opens the door to a morning panic. And I believe I caught some of this short. I don't remember. I mean, this was so many years ago. But this is what I really look for on the failed morning gap up. If you have failed morning spikes, it can turn into a panic when the stock is up too much. And that's what this is all about. You can see this pattern. I don't like trading tickers with a Q at the end. A Q means that the company is bankrupt. And, with bankrupt companies, technically, fundamentally, they're worthless. But you sometimes get these hedge funds that pick up assets for cheap and the stock can spike. And there's rumors that, there's going to be an acquisition in bankruptcy. I never really know how to trade it, but I like this. This is American Airlines. I like this chart where it goes from 5 to 7, and you can see it, it looks all nice and safe. But then it starts fading intraday, and you just get this cliff dive. And again, if you've seen probably, I don't know, 500 out of the 4,000 video lessons that I've done, I've talked about cliff dives. And, you want to get in there on the failed morning spike. And when it starts to fade, you can short it. I've done this several times. Let me pull up HHWW. Let me see if I can pull up that chart. I don't know what's going to pop up. I'm just thinking of charts as I'm saying this. I mean, these are all pumps. These are all from my website, LEXG. Oh, this was a good one. This is on YouTube where it cracks. Oh, that was GNIN. That was beautiful. Let's see. Oh, I can't even move my browser. Hold on. Here's another example. This was actually Shaquille O'Neal's pump, which I shorted, and I was short somewhere in here. I don't remember the exact time, but you can see it crack. This is a one-day chart, and it cracked from 325 down to 175, and I made 12,000, I believe, from a Whole Foods. I was shopping with my ex-girlfriend at Whole Foods when this stock was cracking, and I covered, I believe, at like 194. On NXTH. That was one of the times I shorted that. Shaq got involved with a pump, and then later he sent me a cease and desist letter. But I didn't remove the blog post because, frankly, I was right. Let me see. Here's another one, TNGS. You can see this pump. Look how steady the uptrends are, and then it just cracks. This is the chart. This is the chart I was thinking of, though. This was HHWW. I was shorting this actually at Thinkorswim. And just to give you an idea of how bad I am as a trader sometimes, I believe I was short right here at $2.70. I think I shorted, I want to say 35,000 shares. So if I had just held the 35,000 shares, I mean, it drops $1.50 from my short, or $1.40. So theoretically, if I was a great trader, I could make 50 grand. As it turned out, I vaguely remember shorting 35,000 shares at 270 and getting all excited and covering them at like 250. Or maybe I was short at 250 and covering at 230. But I made 20 cents a share, if I remember correctly on this. So if you ever think, oh my God, Sykes is such a genius, he's such a good trader, I have so many trades to disprove that. It is scary. And my critics like to point that out, saying, oh, Sykes not a great trader. I admit it. Okay? This is why I'm not running $1 billion hedge fund. I am not a great trader. That doesn't mean that the patterns don't work, that the lessons don't work, and that it's not going to help you. And guess what? What I found is that actually my being a not so great trader means that I am kind of like you. So the 4.4 million that I've made now over the years can be made by someone like you. It is not a best case scenario where it's impossible to achieve what I've achieved. It is very possible, and this is a great example of how much money I left on the table. Okay? Let me do a search. Tim's trades. We're going to do a search for all my trades, and I want to show you. Profitly has a cool little thing where you can search by ticker. HHWW. Let's see. Where was my short? Here we go. Made 2 grand. Absolutely terrible. Oh, 3 to 275. My bad. I specifically, I was still short 35,000. So this was before. This was my partial cover where I locked in 2,000. Hold on. Where's the other 35,000? I guess it was here. Okay, so I made 8,000. My bad. But this was my play, and I was short 35,000 shares at 270, and I covered at 254. Absolutely freaking terrible. Okay, the thing closes at $1.30, and I say I missed out on another 35,000 in profits. So it's okay to cover too soon. I still made 8 grand, but this was on my bread and butter pattern. So just consider that for a second. I bring this up not to brag about how bad I am, but just to show you that it's realistic and it's okay to miss trades. I think I actually missed this AAMRQ also. I did nail this one, ISNS. This was up from the 2s to the 9s. This is an intraday chart. You know, here's you can see this is a Tuesday, Wednesday, Thursday, Friday, Tuesday, Wednesday. I think the market was closed on Monday for a holiday. And the stock basically went from 2 to 9. And the whole question was, when was it going to tank? When was it going to crack? And funny enough, remember I was telling you the story about Men's Health magazine where I kind of whipped the Wolf of Weed Street's butt in terms of my market knowledge and being right about the weeds stocks being pumps. We were doing a photo shoot for that magazine article when this started cracking, and I shorted this stock from the photo shoot. So I trade from some random places, whether I'm at Whole Foods or on a yacht or, you know, at a rest stop in New Jersey or at a photo shoot. I don't bring this up to brag about my life, to, you know, say, oh, look at how crazy this stuff is. It's to show you that I fit my trading into whatever I'm doing. And, you know, it's not an excuse. Some people say, oh, you know, you say you would be a better trader if you didn't do all this stuff. I don't even know. If I was at home, I might have covered it too soon anyways. My point is that you can do this from anywhere and you can cover too soon. I believe I shorted this in here in the mid 8s and I covered in the high 7s. And again, it went down to the 6s the next day. But I covered, and I think I made like 6,000 or 8,000 on that one too. Let me just see. There's so many trades in the past, but I remember stopping the photo shoot to trade, and everyone was like, "What are you doing?" Yeah, this was my short. Shorting in the mid 8s, covering in the mid 7s. And that was it, making 10%. And, you know, that was the beginning of the end. It eventually really cracked. But when you make $8,000 from a photo shoot, you take it. And even if I was trading small, you know, short 1,000 shares here in the mid 8s and cover in the mid 7s and make 500 to 1,000, that's the same kind of trade. You will learn that you can scale your positions up later on when you get more comfortable with this strategy. Speaking of, here's FMCC. This is one of the plays that my top student, Tim Grittani, made $200,000 on. And there's a whole blog post on it. You can do a Google search. We'll do it right now. How to make 200,000 in a day, Tim Sykes. This was a guest blog post. And Tim Grittani wrote this post for me. And I was very pleasantly surprised. You know, and he's talking about this. And his pattern, did I show it? I showed a video of him. So I show screenshots? Well, I show the trades. You know, he's making a little here, a little there. Here we go. So look at this. This is, and I brought this up because this is the morning spike pattern that I talked about with GRNH. Let's just scroll back for a second. Which slide are we on right now? We're on 68. But look at this morning spike and fade pattern on GRNH, okay? This is a weed stock that is spiking. It's doubling in the first 15 minutes and then crashing 50% in the next 45 minutes. Compare this chart, okay? This is an intraday chart, so this is a one-day chart. Compare it to this chart. This is a lithium company where the stock goes from 110 to 190, so nearly doubles. And then it drops from 180 down to 70 cents. So it gets cut in half. And now compare it to this play. This is Fannie Mae, where you have the stock go from 4 to 520, and then it cracks 50% here. And then compare it to FMCC, where it goes from 4 to 5, and then it cracks from 5 to 2. And then we have Fannie Mae again. So, you know, let me get back to this pattern here. So this was just one of the many morning spikes followed by a morning panic, and then it's kind of a bouncing ball pattern. I just showed you, 5 unrelated companies. You know, okay, Fannie Mae and Freddie Mac, those two are related. But the other one is a weed stock, and the other one is a lithium company. Why do they all have the same pattern? Oh, that's why. this is my favorite pattern. And what you can learn to do is short into this morning spike. Don't short right at the open or even when it's just going green. I mean, every single minute, look at this, every single minute it's up and then every single minute it's down. You have a nice little bounce here to short. This is what I like doing. I oftentimes miss the first short, like into the true ridiculousness, because I just never know how far it's going to go. I like the first sign of weakness and then shorting this bounce if it fails. So I would be shorting it big, right in here. This is best case scenario where you get a 50% drop and then the thing nearly doubles over here. I mean, this is just tremendous volatility. I know some traders who made six figures in one morning on this, and there's massive volume, so you can take 50,000 share positions, 100,000 share positions, and make $1 a share if you want. That's when you're bigger. That's when you have a bigger account, not in the beginning. You have to get used to it. Try trading with 500 shares. Try trading with 1,000 shares at first. Here's another example, just to show you, the multi-day. So, you see these morning spikes here. This goes from 1 to 150 and then 150 down to 75 cents very quickly. But this volatility has been built up over 1, 2, 3, 4 days of gradual uptrending. And that's what leads to this kind of blow off top here. Same kind of thing here. WSGP, this was a blatant pump and it went from 80 cents up to 190. Again, I'm going to miss shorting this because I don't know if it's going to go to 190 or even 290. But when it has the first crack in the bounce, you're damn sure that I'm going to be shorting this if I can find shares to short here in the 150s, 160s on this little bounce. Because the first crack on a stock that's up this much usually is the beginning of the end. Here's another example, CLRH. I bring this one up because this is a few years old now. But for 2 weeks, they sent out promotional mailers. And the stock went from $1 to $1.75. And then in just 4 days, it goes from $1.75 down to 25 cents. And if you do a blog search, a Google search for CLRH and my name, you will find blog posts of me warning that this was going to crash. They were based out of a Honey Baked Ham store. The promotional mailer, wait, you got to read this. These stories are ridiculous. CLRH, Timothy Sykes. I used to do so many blog posts. Courtney Smith promotes a UPS box based company is to blame. Yeah, so Courtney Smith was the promoter. I think he does options now. But he sent out the mailer, hyping it. This was the UPS store that had the address. Where was it? CLRH. Charles Payne on Fox. He also does this. Hold up. I gotta find this. There's a good blog post that you're gonna laugh when you see this. Or maybe you will if you understand what this is. NXTH, this was Shaq's pump. This was the time that it crashed, and then they sent out another mailer. Here we go. The real reason this penny stock collapsed, 88% in 4 days. This is from 2010. Somebody posted on Yahoo message boards and they say that this is from investor relations. I have no idea if this is true or not, but it would make perfect sense. As a public company, our stock price is subjected to fluctuations. April 20th marked the year anniversary of the company going public via reverse merger, and this enabled original shareholders restricted stock to begin to diversify their portfolios by selling a portion of their shares. This is not selling a portion of their shares. This is a freaking fire sale. So Courtney Smith was hired by insiders to send out a promotional mailer saying how great this company is. And then when their restricted shares finally became unrestricted, and we'll go over that in a little bit, the insiders dumped as much as they could, and it happened all in 4 days. Welcome to penny stock lands. Welcome to pump and dumps. Here's another example, NNRX. I could not find any shares to short of that CLRH, sadly. Sometimes that happens. But here's NNRX spiking for several days. You can see here it doesn't even trade at all in the 70-cent range, and then it spikes up to $1 on a promotional mailer going out. Gullible people are lured in. Oh, reality hits. You cannot trust stocks that run up on mailers. Okay, I don't like any company that goes up on promotional mailers because why why is a company or somebody on behalf of the company sending out these promotional mailers? It's because somebody was paid to do so. Somebody pays people like Courtney Smith. Somebody pays random people out there to send out millions of emails or faxes. There was a WhatsApp promotion the other day, um, and sometimes they leave voicemails. Whatever they can do to lure in financially naive people into these companies, and it works for a few days, and then the bottoms fall out. Go watch the movie Boiler Room if you want to see what happens. The reason it falls out is because once the insiders who have paid for the promotion have sold all their shares, there is no longer any reason to hold the stock. There is no longer any reason to promote the stock because the insiders are all out. And that is why, while it takes, this was 5 days in a row of spiking, on the sixth day, it just collapsed because there's no need to promote it at all because now the insiders have taken their profits. Pump and dump. Here's another version of that. This is a little more legal, where SPHS has been spiking lately, and now it's tanking on rumors of a financing. And as you'll see later in a video about EVOK, you'll see how this ends with these stocks running up. Always, always, always doubt the reasons why any penny stock is spiking. It's either the momentum crowd has a hold of it, maybe some short sellers got squeezed early, or someone on the inside is promoting or hyping the company up so that insiders can dump shares, or the company can raise money at inflated prices. It is the same it's the same formula, and it's just variation after variation on the same formula. Get the low price stock up, and that way insiders or big investors or big traders can basically sell into the spike, and that is terrible. This is part of the reason why I trade with such a small account. I don't want you to ever think that I care about pumping a stock or buying a stock so that the stock price spikes and I sell and I take my profits. I trade with a very, very, very small account in order specifically to show you how to try to piggyback these run-ups. But it costs me more to send out the text message alerts than my trading profits combined. And right now, as I'm filming this in July, I'm up roughly $100,000 on the year. I started the year with just 12,000. I've also traded with a bigger account, so it's not like I've made 90,000 on this small account. My small account has grown to roughly 75,000 now. But all of the money from my trading profits is going to be donated on top of my How to Make Millions DVD, which all goes to charity. But I trade in order to teach, and I think more traders should do that. It's actually pretty enlightening and fascinating to trade with a small account after you've traded with millions. You get better discipline. But long story short, these are the patterns that I like. Let's get into something a little more important, but something that I'm sure that more people are not going to care as much about, even though you should. So with that, I want to talk about risk reward. And this is rated 1 to 20 because you have to plan your risk reward. You have to estimate what is your potential risk of doing that trade. What is your potential reward of doing that trade? What is your reward if you're right? What is the risk that you're wrong? And you can be right on any trade, you can be wrong on any trade. Do not think that just because you have money or experience that you're definitely going to be right every single time. You always have to manage your risk, and you have to consider your risk before you risk your hard-earned money. Too many people go into a trade blind. They're blinded by greed, and they just think about, what can I make on this trade? And let's say the trade doesn't go their way. What happens? Always consider the possibility that you're wrong. Do not be a deer in headlights if the trade goes against you, as I know too many people are. They say, okay, I'm going to do this trade. I'm going to make $500. This is great. I'm all excited. Thanks, Tim. And then instead of making 500, they're down 100. They're down 200. They're down 300. And they freeze. And they email me and they're like, what should I do? It's going down. It's going against me. the same thing every single time. Some people are like, Tim, why don't you set any stop losses? Because I don't need stop losses. My strategy is I cut losses quickly and I stick to that plan. Sometimes I even cut gains quickly and I stick to that plan just because I trade so cowardly. I don't need some automated hardcore stop loss to take me out of the trade where I say, okay, I'm down 10 cents a share. The stop loss is going to take me out. Sometimes I'm down 10 cents a share, but maybe I chase the stock a little bit and I want to give it a little more time. If you put in a hard coded stop loss where no matter what happens with the price action, if the stock hits a certain number that you say I'm out at, well, you might not get that price, first of all. The stock might move too quickly. And secondly, the market makers can see your stop losses. So if you put in a stop loss order, and let's say the market maker sees 50 people with the same stop loss order, the market maker might change the stock price. That means that he will, for however he does it, and I'm not a market maker, I don't know the ins and outs of market making, I don't pretend to, but I know that market makers will it's kind of like sweeping your leg if you're in a fight. And what the market maker does is he sweeps all those stop losses because he's just interested in getting the trading volume up, taking commissions, and he'll take out all those stop losses. So if the stock is, let's say, at $3.10 a share, and everybody puts their stop loss at $3 a share, and the market maker sees that, he drops the stock from 310 to 3. Everyone's stop losses gets executed. Let's say it goes down to like 298, and then the market maker says, "Oh, there weren't that many sell orders anymore, actually. So now let's put it back to 320." So you just got out of the stock for no reason, and you just helped become another victim to market makers. So I don't like using hard stops, but that's me. You can use a hard stop if you want. For me, I like using mental stops. If the stock does not do exactly what I expect, and because I have, experience and history on my side, I have expectations. So if it does not do exactly what I expect, and sometimes what I expect involves me having, risking a little small loss sometimes. Sometimes I'm wrong for a little bit. But that doesn't mean that I'm going to cut losses right away if I already expect those small losses. I will only cut losses if those small losses turn into something bigger, and then it starts really going away from me, and it's a slippery slope. So I keep every single trade on a very tight leash. That's me. You have to choose what works for you. You do not know the exact risk or reward ahead of time. All you can do is estimate. And in order to do that, you use prior support and resistance levels as your guide as to what a stock can do. That way, if you're long a stock and it breaks below support, that's your risk level. If you're short a stock and it breaks above resistance, that's your risk level. I know too many people where they go long a stock, right? They buy a stock, and let's say it's green on the day, it's up maybe 5-10 cents a share, but then it goes red on the day and it's down 5 or 10 cents a share. I know too many people who will hold the stock. These are saying, oh, I'm down just a few cents a share, let me just give it some time. But what they ignore is green to red action. I do not like green to red. If I'm buying a stock when it's green on the day, meaning that it's up on the day, it should not be going red on the day, okay, by very much, if at all. I do not like that momentum swing. And if I'm short a stock, sometimes I'm betting on a stock going lower. Oh no, I'm editing this. I don't want to edit this. If I'm short a stock, right, I'm betting on lower prices and the stock is red on the day. Let's say, I'm shorting it because I think it's the first down day, like on WLOCD. I think that it's going to keep collapsing. Well, what if it doesn't? What if it goes green on the day and I'm short, and it breaks above resistance? That's my risk level. I'm not going to hold a stock short when it's going against me and it can potentially squeeze me as a short. And if I'm a long, I'm not going to hold a stock when it goes green to red on the day because that's a major, major momentum shift. And then if a stock does exactly what you think it'll do, how much will you make? What is your potential reward? So let me go back for a second and bring up a good chart. Let's see. I'll bring up a few charts. So XXII. So the breakout here, I believe, is 175, right? If I'm buying it at 175 or 176, I think it's going to be a breakout. Remember, I want a breakout to be convincing. I don't want just a small breakout. If it goes to like 177 and then comes back down, that's not really a strong breakout. That could be a fake out. So let's say I'm buying this at 176, okay, and it goes up to 188. That's pretty good. You know, a 10 cent a share breakout, and then as I know how the stock turned out, it did go up to the twos the next day. So this was a strong breakout. But if I'm buying this stock at 176 or 177 and it finishes the day at like 172, 170, I'm probably going to exit because it might just be a top. I don't want to risk that. I'd rather lose 3 or 4 cents a share and risk losing. And with buying, you can always get back in. If I am wrong and maybe the next day it is going to break out, I can probably get back in. But if you're buying breakouts or potential breakouts, you don't want to be there if there's a top, especially these speculative stocks lately, because you just don't know how fast they're going to drop. Here's another example on TOPS. Remember, I was buying this here at 228. My potential reward was 257, so 29 cents a share of upside if it got back to the top. Right here, there was support at 210, so call it 18 cents a share of downside. So 29 cents a share of potential reward if it tops, and 18 cents a share of potential risk. So not quite 2-to-1 risk reward, but if it broke 257, I thought it could get to 3. So really 70 cents a share of upside and roughly 15, 20 cents a share of downside. So 3-4-to-1 risk reward. As it turned out, it went up $2 a share from my buy alert. And I think I was down, it closed on the day at $2.22. So I was down 6 cents a share overnight. But let's just do the math here for a second. $2 a share divided by 6 cents a share. Oh, wait. 2.00 divided by 0.06. So it's actually 94-to-1 risk reward. Is that right? 94 times. Wait a minute. Now you're seeing how bad at math I am. 6 cents a share of downside and $2 a share of upside. Maybe I should divide it. Okay, yeah, 33-to-1. That's better. Again, just another example of how bad I am at math and how you can be bad at math. But 33 times the upside there was on this trade versus the downside. Think about that. That is amazing. And that's why it's very difficult for me to ignore trades like that. I didn't know that there was going to be 33 times of upside, but there could be if you catch these patterns right. That's the beautiful thing about penny stocks. You will never get 33 times upside if you're trading Facebook or Amazon or GE. You need to trade this speculative junk. I'm sorry to break it to you. I'm sorry, CNBC. This is why your ratings are at multi-decade lows. What you teach and what you talk about does not reward small investors and traders. And those of you with small accounts, you need trades where you can potentially make 33 times what you can risk losing. And I did not take anywhere near $2 a share. I made 40 cents a share on average, which is fine. Anyways, I am always thinking about what could happen ahead of time. That's what risk reward is all about. And you use past support and past resistance as your guide. I can't explain how important this is. I know you're going to graze over it, as too many people do. I've written blog posts about risk reward. They're my least popular. But having a plan before your trade is so important. And I hope by valuing this 1 to 20 instead of what most people think 1 to 10, you understand that it's a little more important. Again, I prefer trades that have 3 or 4 to 1, but sometimes they can get a 10, 20, or even 30 to 1. But this is the beautiful thing. Risk is always minimal if you're willing to cut losses quickly, which you should. Now, I shouldn't even say always, because if you're buying a stock ahead, let me change this. I'm changing this. if you're buying a stock ahead of earnings or like ahead of an FDA approval decision, you risk so much because you cannot cut losses quickly because the stock will get halted. Stocks get halted when big news is coming out. So I don't like trying to predict big news. And if I'm holding a stock, big news can come out at any time. So that is the risk here. But that said, it's usually minimal if you are not trying to predict news, which I don't encourage you to do. I try to play the reaction. I like the news to already be out. And that reduces my risk even more. But even if I'm wrong, don't let small mistakes turn into potential big disasters by ignoring the risk in your plan. I know too many traders who lose because they don't cut losses quickly, and instead they're like, "Oh, I'm down just a little bit. Let me double up on my position and reduce my, average cost. That way I can get back in the game." And sometimes they double up, triple up, even quadruple their position size when the stock is going against them, just because they're trying to get back, to smaller losses. They might have a smaller per share loss, and that way, if they keep averaging down, and then if the stock comes back just a little, they can escape break even. I know too many traders who trade like that, and sometimes they do get back to break even or even make a little money, and they're like, "Ha, Tim, I told you I shouldn't cut losses quickly. You were wrong." And they judge based on one trade coming back, and then guess what? They learn the wrong lessons and they keep doing it over and over and over again, and more times than not, you will get burned. So please listen to me. It's in my own best interest to create more millionaires. I don't want to see more losers. 90% of traders already lose in this industry. So you have to be less stubborn. Successful traders are not stubborn, and we stick to our plan and we stick to our risk levels laid out ahead of time. That is so, 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 so key. I also have time expectations. For example, I want a breakout or a breakdown to happen the day I enter a position or maybe the next day. If it's taking too long to fulfill those expectations, I may exit some or all of the trade even before it reaches my initial target price. Remember, I am in control of my own trades. You are in control of your own trades. Just because you set a certain risk level or you set a certain reward level, that does not mean that you have to stick to it, okay? You're not taking a freaking oath of office here where you have to do one thing and you cannot adapt. Trading is all about adaptation and reaction. So, risk reward is constantly changing based on your own profits and your own losses and your own expectations and the changing stock price. For example, let's say my goal was to make $1,000 and the current stock price, I take the trade, the current stock price has me up like 700. But, this it's stuck right there. I'm up 1 second, I'm up like 696, another one I'm up like 724, and it's bouncing around 700. And I'm just not sure if it can get to 1,000. Now I must reconsider. What is the risk of me holding longer to try to make that extra $300? You know? What's going to happen? What if the stock goes in reverse and then I'm down 100 and I had my chance to take 700? How am I going to feel about that? So when I'm in a trade, I'm constantly judging. I know my top student, Tim Bertani, he actually likes to ignore his dollar profits and just focus on the chart pattern and let the chart play out. And God bless him, that creates patience. For me, I am always, always scared to death of a stock going against me. Probably because also, I don't have multiple monitors. I'm not trading like all day like some students are. I'm trading from planes. I'm trading from boats. I'm trading from crazy locations and grocery stores and rest stops. So for me, I want to play it extra, extra carefully. And you'll see me oftentimes take profits too quickly just because I start getting uncomfortable. And some people are like, "Oh, Tim, you got to wait until your target price gets hit." Why? Why? Who says that? What rule says you must wait? What rule says I can't take partial profits or all profits whenever I want? I will usually take 2/3, sometimes 3/4 of my original reward plan if the stock doesn't look like it can go any further. On TOPS, Remember, I sold the vast majority of my position in the 250s 30 minutes before it goes to the fours because I wasn't sure if it could break the former high of 257. I don't mind selling too soon. I lock in those profits. And then I held some and I sold some even higher. But my own personal schedule, my own personal cowardice, whatever you want to call it, I want to pass it down to you. I want to teach a whole generation of coward traders. Seriously, that is my hope because it's the coward traders and it's the cowardly reactions that will save you in this volatile industry. Remember, we are trading the single craziest stocks in the entire stock market. And I know it feels good to nail it and to, be gutsy, but guess what? I know too many traders who have lost big. They've lost everything. They have heart attacks. They have stress levels that you don't want to see. So I'm telling you to trade cowardly. And I think that's the best way to be. There's still plenty of money to be made if you're on the right track, even if you're a coward. Thanks to the extreme volatility of low price penny stocks, as I said, sometimes there's even 50 to 1 or 100 to 1 risk reward if all the indicators play out in your favor. And that sometimes does happen. It doesn't happen all the time. It doesn't even happen most of the time. But sometimes it can happen if you're on the right side of the formula. So, for example, if I buy a company with an upcoming media appearance and that appearance somehow goes viral, further than my greatest expectations, well, guess what? That is amazing for me in my position. And this happened with my first $100,000 trade, my first $100,000 profit trade, I should say, when I was just a freshman in college and I took my whole dorm out to dinner. Or sometimes if I'm shorting a blatant pump and an expose comes out, I can't predict exposés, or maybe the SEC halts the stock and I cover for 50, 60, 70, 80, 90% profits on the way down. That happens sometimes too, you know? So if you're on the right track, if you're shorting a blatant pump, yeah, I mean the news that's likely going to come out is going to be bad because you're shorting a fundamentally worthless company. But this is exactly why I don't like buying blatant pumps, you know? I don't want to buy pumps. I want to buy quality and bet against pumps. So the fundamentals are always kind of in the back of my mind. While we're all trading low price stocks, you know some of these companies are better than others. No legitimate company sends out promotional mailers. So any promotional mailer company is a potential short because the downside is too dramatic and too risky to ever really go long. What if you're buying a blatant pump, even if the chart looks great? What if an expose comes out or the SEC halts it? And when the SEC halts it and investigates it and sees that the stock is up only on promotional mailings, when it reopens in a week or two, it opens down 50, 60, 70, 90%. You can never make enough money to justify those risks. But if you're buying a quality company, in quality, as good as can be expected with penny stocks, like a company that just reported good earnings, or a company that just reported a big contract. Now, mind you, bad news can come out at any time and you can be wrong. But for me, it's all about the odds. If I'm buying a company with good odds of earnings or something, you know, the odds say that maybe the press or analysts are going to pick up on that news a little later. Let me go back a little bit. This is slide 78. Let me remember it. I like going back and showing you charts that I didn't properly or fully explain here. So this was an earnings winner, and I'm buying this on the end of day one. And with this lesson that I'm teaching you right now, I'm buying it not because it broke the day high. I'm buying it because I thought that the news was good enough that the analysts and the press would write about it on day two. As it turned out, no press wrote about it, but it kept spiking because not one but two analysts upgraded the stock the next day. Analysts and press and even most investors and traders in this niche are not real time as me. That's the advantage that you can have if you think and if you trade like me. I'm not saying you have to be pinned to your computer right when the news comes out, but recognize on day one when meaningful news comes out. Don't wait until day two or day three. Even when I'm in the Maldives in a few days, I'm going to be checking. I'm not necessarily going to be trading as much, but I'm going to be checking for potential plays. and understanding that some of these plays had legs for days or weeks. So, anyways, let me show you this trade because I did make $100,000 plus in a day as a college freshman. I've talked about it a lot in my book, An American Hedge Fund, which you should have read by now. Um, we have an audiobook also. But I like that by explaining this kind of trade, a lot of people have covered it. I really wish that more traders out there would go in depth with their best trades of all time. We could learn so much from each other and your worst trades of all time. But sadly, the trading industry is full of introverted, weird people, and they don't want to share their stories publicly. They don't like press. They're not comfortable talking publicly, and they don't think about the greater good. I was a philosophy major, so I'm a little messed up in the head compared to all the business majors and finance majors, but I want to share all these trades and all these experiences with you so that you can learn from them, so you can be inspired, so that you can see what I've done right and what I've done wrong. And here was the chart, this Chinese blog. I don't even know what these characters mean. Maybe it just means like lucky son of a bee, right? Like, I don't know what this means. But he covered, or he pulled up the chart, which I don't even have access to. I mean, this was in the year 2000. But this Chinese blogger had access to the chart of Illinois superconductor. I bought it on the week. It was already up from single digits to 17. But they announced on that Friday that they would be on TV over the weekend. And back then, I was, I bought 10,000 shares and I was only worth $250,000. So I'm putting 3/4 of my net worth into this company because this pattern had worked so well. Maybe I was a little too uh, ignorant, and that ignorance was good because it allowed me to bet big. Now I don't care what kind of market it is. I'm never betting 3/4 of my net worth on any one stock. Uh, that's just insane, especially a stock where they have a media appearance where, the media appearance might not happen or the media appearance might be negative. I didn't even consider the risks back in 2000. I didn't have risk reward. I didn't have the rules under my belt. Frankly, I was very lucky. Ignorance is bliss, but at least I did recognize patterns. It closed high. I think it closed at like 17 and a half. So I was already up like $5,000 into the weekend. The news report was very, very positive. There weren't that many exposés in the first few months of 2000. It was just crazy. I thought it could gap up to maybe 18, 19, 20, and I'd make like 30,000. And if I made 30,000, that still would have been my biggest trade, I think, up to that point. But as it turned out, it goes to 29 and it gaps up. And I got a little lucky that everyone loved the press coverage so much. A little luck never hurts. I'm not going to deny that. But I was trying to sell. If you read my book, An American Hedge Fund, I was trying to sell it the second the market opened. There was no pre-market trading back then. I was desperate. I was like, get me out. I want to lock in this profit. And I didn't even have to be, that crazy. The next day, I mean, it went to $30 a share that day, and the next day it goes to nearly $50 a share. So there was $37 a share of upside. So theoretically, I could have made 370,000, but there is no way that I'm holding that long. And it crashed. It was actually a better short on the way down. But that's just an example of being on the right track and being rewarded. And I bet big only because I was such a newbie and an idiot and I had no mentor. Hopefully, you will not get too inspired by this story and actually listen to the words that I'm saying, that I'm lucky and that I was an idiot. And also that was the year 2000, which is the craziest bubble market we've ever seen. Even though we're in a strong bull market right now, I would not say that we're in a bubble like we were back then. So you kind of have to be a little more conservative. Let me tell you about another perfect trade that worked out. This was on Below Deck, season 2. I brought 6 of my challenge students. It was a fantastic, fantastic trip aboard this $12 million yacht. And it turned out to be free, not just for my students, because I was planning on paying for it, but also free for me because I made a big trade that paid for everything, even though they didn't show the trade on TV. I highly encourage you to watch that episode of Below Deck. I come off like a douchebag. They edited it, and I am so happy in so many scenes, and you wonder why I'm so happy. You're like, what kind of guy walks around like this so happy? I was happy because I was in this trade that made me 70 grand. So it doesn't really make sense the way that they framed it, but I'm trading penny stocks. I made people wear shirts that say TimothySykes.com. I don't blame them for making me look like a douchebag. Maybe I am a douchebag, but what you can learn from this douchebag, I think, matters. Here was the news on the stock that really spiked it. 3D printed exoskeleton helps this paralyzed skier walk again. And they take a picture of this paralyzed skier. I think, this is at the Vatican. So it's like, the prayers have been answered. This new kind of like backpack looking thing can help make people walk again. I mean, this is news that has legs, no pun intended. And this is the stock spike that I was buying. I thought I was chasing it a little bit here in the fives. Really the breakout was above the recent range in the mid threes, but it was a bull market and the news was huge, and probably the best excuse for me to buy it and load up in the fives was that this was for a TV show. That's why I bring up the fact that we're on Below Deck. Not to make you want to watch an episode where I look like a douchebag, but because I was on this TV show and I'm trading because I know I'm going to be on this TV show. I have cameras in my face as I'm doing this trade, and I wanted to bet big because I thought that whether I win big or lose big, it's going to make for great TV. So again, I kind of got a little lucky on this that I bet so big. I bought, I want to say, well, I'll see it in a second because I have it written down. But I went big. Um, I bought, I think, like 70 or 75,000 shares here. And if you watch Below Deck, the episode, I mean, I'm complaining about the Wi-Fi. I actually had to call in my broker from, we're in the British Virgin Islands. I had to use my cell phone. This is how old school it was because the Wi-Fi wouldn't work. And I was just betting big. And I was like, all right, the cameras are in my face. I'm going to risk $350,000. I think this is probably one of my biggest bets in the past few years. So thank you, Below Deck, for allowing me to bet so big. And thank you for making me look like a douchebag. And most of all, thank you for this, $70,000 profit that I had. Oh, 57,000 shares. My bad. It was 57,000 shares that I bought. And I was like, it's the third day of the run up, so not a great entry, but the story is explosive and should pick up momentum over the weekend. The CNET article, which I link, and they did do a financing at $1 a share just 2 weeks ago. But I said I'll be aggressive here. My goal is to make $1 a share, and that's exactly what happened. The news did go viral over the weekend. I think Seeking Alpha picked up the story, I think is what it was. And Seeking Alpha, again, used to be a very powerful and influential, website. And so we got a gap up. I'm buying it at roughly $5 a share and selling it at $6.22. Fantastic, fantastic, trade. And, the $70,000 paid for the entire yacht trip for me and my students. So I guess it's good karma to bring your students and to teach. But I just thought that it was kind of cool that I made so much. This is perfect. Best case scenario, this will not always happen. I just want to show you some examples where if you're on the right track, you get rewarded. Here are some of my other students. John Stone made 36 grand. Triforce Trader, who actually just became a millionaire, who's more Superman's student. He made 11,000, and he was buying this in the six range and selling it in the sevens, and he made 27%. This, by the way, is the man who I must thank. This is Blake Alexander. He was a Trading Challenge student who was using an early version of stocks to trade, and he was the one who spotted it. I did not spot the news. Blake spotted the news on the yacht, and he was like, "Hey Tim, this news looks interesting. This chart looks interesting." And so I was in the fives and I was out in the sixes. An hour later, it went to nearly 8. So I left another 150,000 roughly on the table, but that's okay. Or 100,000 on the table. I still made 70,000. I don't mind taking the meat of the move. So Blake, I owe you. Thank you. And here are Blake's trades, by the way. Blake was not trying to bet big on TV. He was just trying to take the meat of the move, and he made 290 on his first trade. And he says, just look at the description of his trade. I love this. Bought this OTC with great story breaking out in the afternoon on Big Dip. Made this trade from a $12 million yacht and the BVIs while eating an uni omelet. That's what I love sea urchin. So I made the chef make some uni omelets. And I know that sounds disgusting to some people, but I loved it. And I'm sure Blake will never think of uni the same. He bought it in the fives and sold at 530. And then he also had 1,000 shares over the weekend. And it's just funny that a student is making $1,300 from a $12 million yacht in the British Virgin Islands. But this trade went perfectly. And then actually the next week, I made another $70,000 trade. I mean, it was crazy. When big trades happen, there's usually big opportunities all around. And this was just a screenshot from a Google video, YouTube video that I made. You can actually watch this video, and it's called "How to Predict Penny Stock Halts and How I Made $100,000." I didn't actually end up making 100,000. I thought that I would, but I took profits at around 70,000. But this, I bring up this screenshot only because I shorted this one big because this was a blatant pump CNTO from 30 cents up to $3. You can see the volume started here. Pretty remarkable pump. But then the volume started fading. I mean, look at the red volume here, and then the volume is really fading here. And you see this big red day. Ignore this little green stump. This is the stock never reopened on this green day. This is just pre-market, and it traded a few hundred shares. So the chart isn't perfect here in this screenshot, but I shorted this on the first red day here. The volume has already faded. It's already had a little bit of a panic. It's had a little bit of a bounce, and now you have this first red day. And this title is a little tongue-in-cheek, How to Predict Penny Stock Halts. You can't predict penny stock halts. I had no idea that the SEC was going to halt this stock that day. What I did know was that I wanted to short pumps when there's fading volume on the first red day. Good things tend to happen. Whether there's going to be a big crash or a small crash, and then there's always the outside possibility that the SEC or some regulatory body could halt the stock because you're shorting a blatant pump. This stock was only up because of promotional mailers, and you can tell by the fading volume already that, guess what? The promotion is probably over. So even if the SEC did not halt the stock, my guess is it would have dropped a little, maybe to like 180 or 150 that day, and I would have made like 20, 30, 40,000. As it turned out, the stock got halted, I think, for, I don't know, a week, 2 weeks, and I covered, I think I had like 84,000 shares short. I don't remember the exact number, but I bet big on this, not because I was on TV but because I was an idiot, but because this was my bread and butter pattern, shorting pumps on the first red day. And I believe I made nearly $1 a share. So roughly 70,000, 65,000. There were some fees because when you're shorting stocks that are hard to borrow and they're halted by the SEC, you have to pay fees on your borrow every single day. So I remember paying a few thousand in fees. You can look this up on my, history. But overall, I made another roughly $65,000 shorting this one. So buying good stocks with upcoming media appearances or news that might have, the ability to go viral, or shorting pumps on the first day. These kinds of perfect situations don't come about every single day. And even if they do and you're in them, does not mean that they're going to end up perfectly. But I just wanted to show you some examples of where you can win huge if everything plays out perfectly. Where if you're just scalping for like 2 or 3 or 5 cents a share, or if you're trading, random patterns or random, stocks without catalysts, like if you're not trading pumps, or if you're not trading low float, low market cap stocks that can really double or go up, even 500% in a day like we've seen lately, you're missing out on that, big potential winner. And this is nice. I've done this several times throughout my career, and I know several students have too. So, well, what is this? Let me bring up one more link before I end this segment. Dimly slash, what is it? Sykes 5X. I create all these little shortened URLs to try and remember them. Here we go. So this is my student Sid, and PRGN was a big spiker. Paragon Shipping. And this is a company, again, no major analyst or, really veteran stock market person would ever say trade this. They would say, if you're trading this, near bankrupt company, you are insane. And whoever is telling you to trade these companies is a scam artist. Well, guess what? Here is Sid. I can't show you it. How do I make this screen bigger? Hold on, one sec. Aha, I paused it and I made it bigger. Here you can see his buy at 62 cents on April 28th. And again, not every trade is going to do this. In fact, most won't. But PRGN was one of the first to set off this wave of low float, low market cap stocks that can go truly, supernova and parabolic all within a day or two. And it's because they have such low market caps and low volumes. And he bought it 700 shares at 62 cents. So he's putting in roughly $400. And again, I get so many people who say you can't trade with such small amounts. It takes money to make money. And this is why I saved this trade from Sid. And thank you, Sid, for sharing your screenshot. I missed this, okay? I personally hesitated. I did not trade it. I know like half my chat room played this, and they didn't necessarily buy it at 62 cents and sell it the next day at 332. This was near best case scenario. But I know a lot of people that bought it at like 80 cents or 90 cents or a dollar and sold it at $1.20, $1.50, $1.80, $2. And they made 50 to 100% on their money. This is an extreme example. But again, this can happen. This is the outlier potential that can happen for you if you really catch a hot trend, if you catch, a tiger by its tail. So he bought it at 62 cents, sold it the next day at 332, turning $434 into 2,300 literally overnight. And he's using market orders, which I never suggest. You should use limit orders. But this is freaking awesome. And this is why penny stocks are awesome, So if anybody has any doubts, if you have friends or families or people on social media who give you crap about trading penny stocks, I want you showing them this screenshot. Okay, pause this video right now, take a screenshot, and see. This is not. It's not like the. Sometimes you see a penny stock go from 60 cents to $3, and the volume is like 12,000 shares. The volume was 4.5 million shares. Okay, you could have bought 20,000 shares. You could have bought 100,000 shares and done this trade. I'm not saying to do that because the vast majority of low flow plays and penny stocks will not do this. But we've seen this kind of supernova not once, not twice, but I would say probably a dozen times now in 2016. So roughly 2 per month. And the past 2 months, there's been like 5 or 6. So it's been above average. But just like my ISCO trade or my CNTO trade or my EKSO trade, those might have been bigger dollar amounts. Every now and then you can really nail it if you're dead on. And whether you have $400 in your account or 40,000 or 4,000, you get more comfortable. And trust me, if you stick with this long enough over several years or ideally over several decades, you will catch several like this too. And this, besides the money that you make, the adrenaline rush, the opening your eyes and changing your mindset about how to make money and what plays to focus on in the stock market, it's invaluable. You know, that first day that I made $100,000 in a day as a college freshman, I mean, I could not even get into bars. I had 3 fake IDs taken away. All my friends were getting into fraternities. Because I was into trading, I couldn't even be in a fraternity. You know, I was using Merc to like download little movies in my freshman dorm room. It was a ridiculous lifestyle, and I made more than what many qualified lawyers and doctors make in a year in one day. So just think about these kinds of outliers. And even though they're not going to happen every day, they are something to remember and to know that it's possible if you are on the right track.
My name is Tim Sykes, and I teach people to trade stocks. I am a self-made multimillionaire.
So this is the ideal trade that I'm going to talk about. I want you guys to understand every single aspect of this trade.